How's it going, everyone? My name is Dan, but you can call me Malone, and if you've clicked on this video, you're probably considering investing in ETFs, or you're already investing in ETFs and you want to make sure that you're not doing anything stupid. Regardless, you're in the right place. ETFs have quickly become the darling child of the investing world, and it's no surprise why. They allow the likes of me and you to own a large number of investments for one single convenient price. However, like everything in personal finance, there are do's and don'ts when it comes to ETF investing. What you don't do is arguably more important than what you do, and making solid, informed investing decisions can save you hundreds of thousands of dollars and euros over the long term. So with that being said, in this video, I'm going to break down in plain English the do's and don'ts of ETF investing for beginners. If you're new to investing, you're probably feeling overwhelmed, but don't worry, you are most certainly not alone. And by the end of this video, you'll know exactly what you need to look out for when investing in ETFs. If you do enjoy this video and want to see more like it in the future, don't forget to leave a like and subscribe to the channel. Let's start off with the obvious. Don't invest in ETFs without understanding ETFs. ETF stands for Exchange Traded Fund, meaning an ETF is an investment fund which is traded on the stock exchange. Shares in ETFs are bought and sold by investors in the same way as they might buy and sell shares in companies. However, unlike shares in companies which represent an ownership interest in one singular entity, ETFs allow investors to gain exposure to a large number of company shares by simply buying one single share in the fund. Let's take an example. Many ETFs are index-linked products, better known as index funds. The goal of an index fund is to allow investors to earn an investment return which mirrors the performance of a particular stock market index, like the S&P 500. A stock market index is a tool which is used to measure the performance of a collection of investments. For example, the S&P 500 index measures the stock performance of the top 500 companies in the United States. So an S&P 500 ETF will own shares in the companies which are measured by the S&P 500 index. And by buying a single share in the ETF, an investor can gain exposure to 500 different companies. This is why ETFs are said to be highly diversified investments. ETFs should not be confused with mutual funds, which are another type of investment fund. The key differences between ETFs and mutual funds are that ETFs are bought and sold on the stock exchange, whereas dealings in mutual funds go directly through the investment manager who provides the fund. The price of ETFs on the stock market is constantly changing, whereas the price of mutual funds is only updated at the end of the trading day. And ETFs have no minimum investment amount, whereas most mutual funds do. Now let's talk about ETF holdings. Don't invest in ETFs without knowing what the ETF invests in. There's around 8,000 different ETFs available across the globe. It goes without saying that not all ETFs will invest in the same assets. ETFs can invest in stocks, bonds, commodities, currencies, and more recently, even crypto. Remember, by buying a share in an ETF, you're gaining exposure to the performance of the investments which the ETF itself owns. Meaning, if the ETF invests in volatile assets like crypto, then the share price of the ETF itself will be volatile. That's because the share price of an ETF is determined by the net value of the investments which the ETF owns, in addition to supply and demand factors. If the value of the ETF investments fall, so too will the ETF share price. Knowing what the ETF invests in is also important for understanding the level of diversification you're getting from your investment. Yes, ETFs are diversified investments because they own many different companies' stocks, bonds, etc., etc. However, the quality of that diversification depends on the companies themselves and the industries in which they operate. For example, the ARK Innovation ETF and the Vanguard S&P 500 ETF are both ETFs which invest in stocks. Both of these ETFs offer a certain level of diversification to investors because they own stock in more than one company. However, the quality of diversification between these two funds is radically different. The ARK ETF invests solely in companies who are engaged in disruptive innovation, i.e. the development of technology which has the potential to change the world. Many of these companies are in the early stages of their life cycle and may have little in the way of earnings today. The ARK fund managers are essentially trying to pick the companies who they believe will be the big winners of the future and currently invest in 36 such companies. This is a high risk, high reward play. The S&P 500 ETF, on the other hand, invests in the 500 largest companies in the United States spread across 11 different sectors. Clearly, the quality of diversification is better in the S&P 500 ETF, as the ARK ETF is highly concentrated on early stage disruptive companies who may or may not become industry leaders in the future, whereas the companies in the S&P 500 represent 80% of the total value of the US stock market. A night and day difference. So it's important to know what the ETF invests in, but don't invest in an ETF without knowing the weighting of the investments within the ETF. Using the ARK ETF as an example, we can see that Tesla accounts for 8.4% of the total value of the ETF's investments. Therefore, the performance of this ETF will be heavily reliant on the performance of Tesla. The other way to look at it is that a 10% fall in the share price of Tesla will have a greater impact on the value of the ETF as a whole as compared to a 10% fall in the share price of Spotify. S&P 500 ETFs are no different, with the top 10 companies accounting for nearly 30% of the total value of the fund, meaning the performance of the ETF will be heavily reliant on the performance of those 10 companies. The bottom line, ETFs provide exposure to many different companies, but the extent of that exposure is different for each company. If you're enjoying the video so far, consider showing your support by leaving a like and subscribing to the channel. Also, if you're a beginner investor and are looking for a one-stop shop where you can keep up to date with the latest investing news, access research and opinion pieces from verified authors, and quickly analyze the financial performance of companies, then look no further than Seeking Alpha. I've been using Seeking Alpha for 5 years. I'm on the site every day, and because they're part of my affiliate network, you can get 50% off the premium membership by using the link in the description of this video. Any questions, just let me know. Let's get back to ETFs. Next, don't invest in an ETF without confirming the structure of the ETF. When we talk about ETF structure, we're generally talking about physical ETFs and synthetic ETFs. The main difference is that with physical ETFs, the fund actually owns the investments which it provides exposure to, whereas with synthetic ETFs, the fund uses financial contracts known as swaps to artificially provide exposure without owning the investments directly. The vast majority of ETFs which invest in stocks and bonds are physical ETFs, whereas synthetic ETFs are more common when investing in commodities. Synthetic ETFs come with higher counterparty risk because the investment strategy involves contracts between two parties, and counterparty risk is the risk that the other party fails to meet their side of the deal. Most investors will want to invest in physical ETFs because of their simplicity and lower counterparty risk. The other structural point to check before investing in an ETF is whether the ETF is leveraged. When we talk about leverage, we're generally referring to the use of borrowed money in an investment. The most common example would be purchasing a home using a mortgage. Whenever you hear the word leverage, think of the word amplify. Using leverage in investing allows you to amplify any gains you make on the investment, but equally, leverage will also amplify your losses. Leveraged ETFs use borrowed money and financial contracts like options to multiply the daily returns of the investments which the ETF provides exposure to. If you're planning on investing in a leveraged ETF, it's really important that you understand how they work and the risks involved. The main thing here is to not stumble into a leveraged ETF by mistake. Let's talk about fees. Don't invest in ETFs without checking the total expense ratio, or TER, of the fund. The total expense ratio is sometimes referred to as the management expense ratio, or MER. Essentially, this gives you a measure of the total costs associated with managing and operating the ETF, i.e., how expensive it is for you, the investor, to own the fund. Expenses incurred by an ETF include everything from fees paid to the fund manager, trading costs, fund accounting expenses, custodial services, taxes, legal costs, licensing fees, and audit fees. All of these costs reduce the value of your investment. However, it's very likely that if you didn't know about the total expense ratio, then you'd never even notice it was there. That's because you'll never receive a bill for the charge. It all happens automatically within the fund. Let's use our two examples from earlier to showcase the impact of the total expense ratio. The ARK Innovation ETF has an expense ratio of 0.75%, whereas the Vanguard S&P 500 ETF has an expense ratio of 0.03%. Just a quick note, at the end of the video, I'll show you where you can get all of this information on any given ETF. So let's say we invest $1,000 in both the ARK ETF and the S&P 500 ETF. The ARK ETF has a total expense ratio of 0.75%, meaning it would cost us $7.50 to own this ETF with a $1,000 investment. The S&P 500 ETF, on the other hand, has a total expense ratio of 0.03%, meaning it would cost us 30 cents to own this ETF with a $1,000 investment. This means the S&P 500 ETF is 25 times cheaper than the ARK ETF. Note that the expense ratio is charged every year. Now, you might think that these are small numbers, but we can actually calculate the impact of total expense ratios on investment returns over the long term. Using this calculator by the Nerd Wallet, we can simulate investment performance under different fee structures. We'll assume a $1,000 initial investment with additional $10,000 annual investments each year for 40 years. We'll also assume a 6% rate of return. With an expense ratio of 0.75%, we end up with a fund value of $1,359,463.87 after 40 years, losing over $290,000 to fees. However, with an expense ratio of 0.03%, we end up with a fund value of $1,637,868.44, losing only $12,894.11 in fees. The difference here is greater than $250,000. Granted, an investor in the ARK ETF would expect an annual return which is much greater than 6%. However, the point is that seemingly small percentages can add up to very large amounts over 40 years. Hence why it's so important that you compare total expense ratios between ETFs before making an investment. Next up is dividend status. Don't invest in an ETF without knowing whether the ETF pays a dividend. Remember, the fund owns the underlying investments, which may include company stocks. Therefore, the fund will be entitled to receive a dividend should the underlying companies pay a dividend. What the fund does with this dividend varies on a case-by-case basis. For dividend purposes, there are two types of ETFs: accumulating ETFs and distributing ETFs. Accumulating ETFs will not pay you a dividend. Instead, the investment income received by the fund will be reinvested automatically for your benefit. Distributing ETFs, on the other hand, will pay out a dividend directly to the brokerage accounts of ETF shareholders. In the past, I made the mistake of investing in distributing ETFs when in reality I wanted to invest in accumulating ETFs. So I had to sell out of my position and reinvest into new ETFs. Best to avoid that if possible. Knowing the dividend status of your ETF is important not only from an income perspective, but also from a tax perspective, depending on where in the world you live. That brings me on nicely to my next point. don't invest in an ETF without understanding the tax implications. If you've watched any of my tax videos, you'll know that one of my biggest gripes with personal finance YouTubers is that they don't make it crystal clear that tax rules are different in literally every single country around the world, meaning it will be a waste of my time and yours for me to sit here and explain the ETF tax rules as they apply to me. Unless of course you live in the same country as me, in which case click the video popping up on screen. What you should do is go to the YouTube search bar and type in how ETFs are taxed in, insert your country name, watch a couple of those videos, and if you're still unsure, then maybe dish out a bit of money for a tax consultation. But don't invest without knowing your tax position. The best way to invest in ETFs is going to be through an online brokerage, but don't invest in an ETF before you've picked the right brokerage for you. Different brokers will have different fee schedules for investing in ETFs. Some brokers will charge no commission when buying and selling ETFs, whereas other brokers might. Remember, fees have a very real impact on your investment returns over the long term, no matter how small the fee may seem. So you should be doing everything in your power to minimize the fees you're paying. If you're from Europe and you want to invest in ETFs commission free, then you can sign up for a free account with DeGiro or Book0 by using the links in the description of this video. If you prefer investing on PC or laptop, I recommend DeGiro, and if you're more of a mobile investor, then Book0 is a good option. For all my non-European viewers, it's really just a case of researching who the low-cost brokers are and making a decision as to which one seems right for you. Bottom line, do your research and make sure you're not spending more on broker fees than you need to be. Now let's talk about liquidity. Don't invest in ETFs without understanding ETF liquidity. When we talk about liquidity, we're talking about how easy it is to sell our investment without having to sacrifice the amount of money we receive. The more buyers and sellers there are at any given time for any given investment, the more likely it is that a fair market price will be received for that investment. When it comes to normal company stocks, we generally look at trading volume to get an idea of liquidity. Higher trading volumes equals higher liquidity, and higher liquidity is good. However, I made the error of applying the same logic to ETFs, when in reality it's not the same. Low trading volumes for ETFs on a particular exchange does not necessarily mean low liquidity. Instead, the liquidity of an ETF is dependent on the liquidity of the investments which the ETF holds. We haven't delved too deep into the inner workings of ETFs for the sake of simplicity. All you need to know is that the supply of ETF shares on the stock market can be adjusted on the fly in order to meet investor demand. This is made possible by large financial institutions acting as so-called authorized participants, or APs for short. APs work with the ETF provider in order to create or redeem ETF shares. If the investments which the ETF holds are highly liquid, meaning there's no shortage of buyers and sellers, then APs will be able to adjust the supply of ETF shares as needed to match investor demand, meaning the likes of S&P 500 ETFs will have little to no liquidity issues irrespective of trading volumes, whereas ETFs which own more niche investments with lower liquidity might run into some problems. Bottom line, daily trading volumes are not as useful for gauging ETF liquidity as they are for gauging stock liquidity. Last but certainly not least, don't invest in ETFs which are misaligned with your own personal circumstances and investment goals. Every financial decision you make must be made in the context of you as an individual. The investing journey does not start with an investment. It starts with an analysis of oneself. Where are you at in your life? Where do you want to go in the short, medium, and long term? What's your financial situation? Your attitude towards risk? All of these things have to be considered before you even think of investing in anything, be it ETFs, stocks, or crypto. Once you have those things figured out, the path becomes a lot clearer. Maybe you realize that you're risk averse, and so you know that leveraged ETFs or speculative ETFs probably aren't for you. Maybe you turn around and say, hey, I'm in my 50s, so I probably shouldn't invest 100% into equity ETFs. In the words of Yogi Berra, be careful if you don't know where you're going because you might not get there. So that just about wraps up my 10 ETF investing do's and don'ts for beginners. I want to close by showing you where you can get all of the information on ETFs, which we refer to throughout the video. What you need to do is Google the name of the ETF you want to invest in, followed by fact sheet. So you can see here I have the fact sheet for the iShares S&P 500 Euro hedged UCITS ETF accumulating. Even by breaking down the name of this ETF, we can get some key information. iShares is the name of the ETF provider. It's an S&P 500 ETF. It's Euro hedged, which means my investment is protected against adverse currency movements. It's a UCITS fund, which stands for Undertakings for Collective Investments in Transferable Securities, meaning it has the EU stamp of approval. And finally, it's an accumulating ETF, meaning dividends will be automatically reinvested. On the fact sheet, we can see the investment weightings, the ETF structure, which is a physical ETF, the total expense ratio being 0.20%, meaning we're paying €2 in fees for every €1,000 invested, and the dividend status being accumulating. If the fund were leveraged, that information would also appear here. The SEC in the US requires ETF providers to disclose daily portfolio transparency data, and so if you go onto any of the providers' websites like Vanguard, you'll be able to see the most up-to-date portfolio holdings, which won't be reflected on the fact sheet. In Europe, the portfolio data seems to be updated on a monthly basis, and so you may find it challenging to get the most up-to-date holdings information. If you have any questions at all about anything we covered in this video, or just investing questions in general, please do leave them in the comments below and I'll do my best to answer them. So I really do hope you enjoyed the video here today. As always, if you did enjoy the video, please do let me know in the comment section below. Leave a like on the video, subscribe to the channel, and I'll see you in the next one. Cheers.